What if I told you the price of crypto doesn't matter as much as you think it does? One of the first things a lot of new crypto investors look at when deciding which cryptos to invest in is its price. The going theory for many that I have seen is that they assume that if they can invest in a lower price crypto, that they have a better chance of making a good return when that crypto goes from a lower price to a higher price. This has especially become popular in the DeFi space, with many crypto projects having a starting point of 0. several zeros 1. This has led many new investors to assume that the price of that crypto is able to rise just 1 penny or even just knock off a few zeros. They can see some wild returns. But is this line of thinking factually accurate? Although it is true that investing into a successful cryptocurrency early at a lower price will indeed lead to a higher returns on their investment, not all cryptocurrencies at lower prices are new or are going to be successful. One of the many major factors that helps dictate the price of a cryptocurrency is actually its supply. Typically speaking, the higher the amount of tokens or coins that exist, the lower the price per token or coin is going to be. Of course, the supply is not the only factor, but it is significantly easier for a token or coin with a lower supply to start at a higher price than a coin or token with a higher supply, as there are fewer coins or tokens to meet demand. It is actually because of the extremely high supply that many of these newer DeFi tokens start out with such an extremely low price. To give an example, this is not only true with crypto, but with other things as well. With fiat currency, the more money that is printed, the lower the value per unit of currency. This is because there is a larger supply with the same demand, therefore leading to a lower value per unit. Of course, assuming the value of that currency and therefore the demand hasn't risen. This typically leads to what is called inflation. Another example, of course, is trading cards. The copy of cards that are more common are typically going to be worth less in value, as there are more of them and they are easier to obtain. However, cards that are rare, due to them being fewer in number and therefore harder to obtain, are typically worth much more money. So how does this apply to cryptocurrency? A lot of DeFi projects start off with supplies of trillions or even quadrillions of tokens. This has been speculated to have been done intentionally by many project developers, as it leads to an illusion for inexperienced investors to assume that because they are getting millions, billions, or even trillions of tokens at extremely low prices, that they're going to see some serious returns when those tokens or coins become worth significantly more money after knocking off several zeros as the price rises. If the cryptocurrency did indeed knock off those zeros, it is true that they would see some large returns, especially as an early investor. But this is not because of the large number of tokens that are held or the lower price that brings about those larger gains. It is the difference between the value you purchase them at and the value you sell them at that truly matters as an investor, or the percentage at which the price rises over time when you go to realize your gains. Although it is true that more tokens will generally lead to lower prices per token, a lower price per token doesn't guarantee or even suggest that a change or especially an increase in that price is more likely. Of course, none of this occurs in a vacuum. Therefore, if the broader investing population believes a lower price crypto will succeed, it can become a self-fulfilling prophecy, as several people put more money into the project and cause a bull run on that cryptocurrency, which leads to a Fomo cycle and entices newer investors to jump on board as well. However, these types of cycles are generally short-lived and should be something to look out for when investing long-term. To give you an idea of what I mean, let's compare two different examples. In the first example, let's say you put $100 into crypto A, which has a current price of 0.501. This would mean you receive 100 million tokens of crypto A for that $100 investment. In the second example, let's say you instead put $100 into crypto B, which has a current price of $1. This would mean you receive a total of just 100 tokens of crypto B. Many new crypto investors would assume that because you bought in at a lower price in crypto A and received more tokens, that you have a higher chance of better returns than investing in crypto B with a higher price and fewer tokens. However, what the price alone doesn't show is that the amount of wallets invested into the project, the market cap, volume, utility of the project, and other extremely important factors. Price as a metric alone tells us little to nothing and can be deceptive. To give an example, many new investors would assume just from the price that crypto A has less money invested into it and a better opportunity due to its price. But what if crypto A has a massive supply at 100 quadrillion tokens and already has millions of holders with billions of dollars invested? And its recent price action was purely built upon hype from the most recent bull market, while crypto B is a brand new coin on its own blockchain with a significantly lower supply at just 50,000 coins and just a few $100 and a real use case and utility set to disrupt the market, and backed by a trustworthy development team that launched just a few days ago. Now, none of this would be obvious just from the price. It would have taken much more due diligence or research into the project to find that information out. After finding that out, however, many investors may rather invest in crypto B due to its future potential, even though it has a higher price per coin. Of course, these comparisons are a bit extreme and oversimplified, but done so on purpose to drive home a point. But it goes to show that price isn't the metric to which you should be giving much attention. Now, let's assume that all those other metrics for both crypto A and crypto B outside of price are completely similar and the supply and demand factor is appropriately balanced according to their price, with crypto A having a significantly higher supply compared to crypto B to make that possible. If both projects were to see similar interest and levels of investment from new investors, this would actually mean that although they have different supplies and prices, they would both experience very similar increases to those prices. Let's assume a 10x due to similar market trends that led to a bull run. That would mean that crypto A would be worth 0.401 per token and crypto B would be worth $10 per coin. Although you have more tokens in crypto A and crypto B is significantly higher price per coin, both your investment in crypto A and your investment in crypto B would be worth the exact same amount. This is because your 100 million tokens in crypto A at 0.401 is worth $1,000, and your 100 coins of crypto B at $10 is worth also $1,000. Just because a crypto has a higher price doesn't mean that it is better or worse in any way compared to a crypto with a lower price and vice versa. As we went over in this video, make sure that when comparing or looking into cryptocurrencies, you compare several other factors outside of price to determine your investment decisions, such as volume, crypto utility, broader market trends, exposure, and other important factors. Because after all, the price isn't what matters. The real metric that matters is the change of price over time and the variables that will drive that change as you invest. Of course, as always, none of this was financial advice and is intended for educational and entertainment purposes only. If you are new to my channel, don't forget to subscribe as I regularly produce content just like this where I go over crypto basics as well as deep dives into specific projects. Thanks for watching, guys, and I will catch you in my next video.